Hey dude, let me just sit down and tell you everything that's been going on with Ripple, XRP, Circle, Coinbase, and this whole Clarity Act drama. It's been a wild few days, and there's so much stuff happening behind the scenes that I want to make sure you hear it all nice and slow, like we're just hanging out talking. So, first off, the Community Bank Group, they're called the ICBA, officially sent a letter yesterday to the OCC. That's the Office of the Comptroller of the Currency. In that letter, they're straight up asking them to say no to giving trust bank charters to Ripple and Circle. And honestly, this isn't anything new. There have been tons of these kinds of notices popping up lately, all trying to stop Ripple, Circle, Paxos, and a few other crypto companies from getting these special trust charters. People are wondering if any of these letters will actually work, or if they're just noise, but the old school banks keep sending them anyway. They really don't want these crypto companies getting that kind of official banking status. We were all waiting for something else this week, too. The newest version of the Clarity Act, the full text of the bill, was supposed to be released to the public so everyone could read it. But that didn't happen. It got delayed again, which is pretty frustrating for a lot of people who've been following this closely. On the other side of things, the CEO of Tether came out and said he thinks Coinbase should back down from fighting against the Clarity Act. He basically told them to stop blocking it. Now, here's why that matters. We found out some real numbers. Coinbase makes about $1.35 billion every year just from their partnership deal with Circle and USDC. That's a massive amount of money. In fact, it adds up to roughly 20% of Coinbase's total revenue. So you can see why some of their business activities would get directly affected if certain parts of the Clarity Act pass. That's probably the main reason Brian Armstrong and the whole Coinbase team are fighting so hard on this. It's hitting their wallet pretty directly, but the wider crypto community is starting to push back. A lot of people are saying, hey, enough is enough. This isn't only about how much money Coinbase is making. Sure, 20% of their revenue coming from this one deal with Circle is huge, but the Clarity Act is supposed to help the entire crypto industry, not just one company's profits. I've seen quite a few people on X who have Coinbase accounts calling them out and asking whose side they're really on. It's getting a bit heated in those comment sections. We really need this Clarity Act to move forward. If we don't get the text out soon and get it passed in the next 2 to 4 weeks, there's a real chance it might not happen this year at all. Midterms are coming, and once politics shifts into campaign mode, big bills like this often get pushed aside or die completely, so the clock is ticking. Let me explain what the Clarity Act actually is because it's super important. This bill would finally define whether different tokens are commodities or securities. That clear line has been missing for years, and it's caused so much confusion and fighting. The act would protect developers, make self-custody safer and more legal, and give the whole crypto industry a solid legal framework that people have been begging for since 2020. It already passed the House of Representatives with really strong bipartisan support, 294 votes yes and only 134 votes no. That's a big win. But then it got to the Senate, and that's where things got stuck. Coinbase has basically blocked the Clarity Act twice already. Back in January, Brian Armstrong pulled their support at the very last minute, literally the night before a key markup session, and the whole thing got canceled. Then in March, the White House stepped in and helped broker a compromise between the different sides. But Coinbase rejected that compromise too. So now it feels like the bill is frozen because of them. The main fight right now is over one specific thing: stablecoin yield. Traditional banks really want to ban any kind of yield or interest on stablecoins, and Coinbase makes around $800 million a year from this. Actually, a little more when you count everything. That's why they're digging in their heels. But here's the thing that frustrates a lot of XRP holders and others in the space. The Clarity Act covers so much more than just stablecoin yield. It talks about token classification, giving the CFTC proper authority, rules for tokenized securities, and strong protections for self-custody rights. All of that good stuff is now stuck because of this one single feature that doesn't even affect most regular crypto users. It almost feels unfair when you step back and look at it. Imagine you've been fighting a big court case for 4 long years. You finally win. The judge rules clearly in your favor. And then, just when a new law is about to make that victory permanent and give everyone clear rules, someone who wasn't even part of your original fight steps in and blocks the whole thing, simply because it hurts their paycheck. That's pretty much exactly what's happening to XRP holders right now. Think about what Ripple went through. They fought the SEC for 4 full years. They dealt with delistings on exchanges, constant FUD, and tons of uncertainty hanging over the whole project. Through all of that, they stayed focused. They built RLUSD the right way, compliance first, no crazy yield drama, and they didn't lobby against important legislation. Now Ripple is making real moves. They're working inside the DTCC, partnering with BNY, running pilots with central banks, and building actual utility while some other companies are busy fighting against new laws. A lot of people in the community are worried that if the Clarity Act doesn't get done by May, the midterms will take over Congress and the bill will probably die for this year. That would be a huge setback for the whole industry. Let me give you the exact money numbers again so it's clear. Coinbase and Circle together generated somewhere between $2.57 billion and $2.75 billion from USDC reserves in 2025. About 60% of that money flowed straight to Coinbase. That lines up with the $1.35 billion revenue figure we keep hearing. On top of that, Coinbase takes a 35% commission on staking rewards for pretty much all the major coins, stuff like ADA, SOL, AVAX, DIOT, and others. They're making a lot of money off regular users who stake their coins on the platform. Some people are starting to feel like Coinbase's actions are more about protecting their own profits than truly helping the broader crypto community. Senator Lummis tweeted toward the end of March that the Clarity Act is honestly one of the best things that could happen for DeFi. She said it would finally give the DeFi community the legal certainty they deserve. Developers, validators, and node operators would all get safe harbor protections. That means they could build and operate without constantly worrying about breaking some unclear rule. And it would help make sure American innovation stays right here in the United States instead of companies moving overseas because the rules are too messy. There was this interesting interview where someone asked a White House person what they want to see in the bill. In plain English, the guy said they want fairness for regular American consumers. We all know that normal savings accounts at banks pay really low interest rates. They've been low for a long time. So the White House wants more competition in all parts of the market, including interest rates. They want a market structure bill that lets people in the US and even abroad access tokenized assets quickly, cheaply, safely, and get paid a reasonable fee or interest rate on their deposits. When the interviewer asked how close they are to getting that done, the response was that these things are always very complicated. He reminded everyone about the Genius Act, which was about regulating stablecoins. It looked like it passed easily, but there was actually a lot of last-minute negotiating behind the scenes. The Clarity Act is an even bigger market structure bill, kind of like the old Commodity Futures Modernization Act from years ago. These kinds of huge, important laws always involve a lot of horse trading right up until the final moments. Still, prediction markets were showing around a 70% chance of it passing at that time. The feeling was that the grown-ups were all at the table, working hard to do what's best for the country and to keep American capital markets the strongest in the world. There's seriously so much going on behind the scenes that most people don't see. Google's AI team put out a report recently about quantum computing and how blockchains are preparing to become quantum resistant. There was some really good detailed information in there about the XRP ledger and a few other chains. We can talk more about that later if you want, but it shows that even the biggest tech companies are thinking seriously about the future of blockchain tech. I also saw this short clip with BlackRock's head of digital assets, Robbie Mitchnick. He was having a casual chat about tokenization. He said that eventually, in his mind, all assets are going to be tokenized. Someone asked if he agrees with that idea, and he replied that he thinks there's a very decent chance of it happening. He doesn't believe it's a total sure thing yet, but that's okay. The level of change and impact, if it does happen, would be massive. It would touch the entire financial system, change infrastructure, shift the roles that different players have, and completely change how markets operate, how investors get access to things, and what kinds of exposure they can have. He pointed out that you don't have to be 100% certain to start making big bets. You just need to believe there's a real material probability that it's coming. A lot of us humans struggle with uncertainty and probabilities that sit somewhere between 0 and 1. But there's good reason for big institutions and smart players to be taking significant steps right now in preparation for what could happen. That whole conversation makes you think. Right now, if you look at the data, public attention to the crypto market is as low as it's been in the last 5 years. Almost nobody outside our little bubble is paying attention anymore. It really feels like most retail traders have completely stepped away from crypto at exactly the wrong time. Meanwhile, look at what's actually happening in the big world. NASDAQ, the DTCC, the New York Stock Exchange, all these giant institutions are actively moving forward with tokenization projects. Central banks around the world are pushing ahead with their plans for central bank digital currencies, whether those are wholesale or retail versions. Broker-dealers, major financial institutions, everyone is quietly building toward a tokenized future. But a lot of regular people are just seeing the current market prices and saying, nah, the market's down, I'm staying out. Those people are thinking super short term. They're not looking 5 or 10 years down the road. And that's unfortunate, because this might be one of the only windows in the next few months where you can still reposition yourself for the long haul. Once crypto assets start being used as real infrastructure and utility takes over, You probably won't see those crazy 80 or 90% price pullbacks anymore. Sure, some chart analysts are saying summertime could be a bit rough for crypto prices. There are a bunch of big macro events happening that make it hard to predict exactly whether the market will go up or down in the short term. But the smart move is to start thinking long term, the same way institutions do. If you're still thinking like a typical retail trader chasing quick moves, you might miss the bigger picture. Institutions almost always end up winning in the long run because they play the long game. Speaking of big institutions, Franklin Templeton has been making some serious moves lately. They just acquired a digital assets platform in the last few days. And they've been quietly working with Ripple, Solana, BNB Chain, Canton, Stellar, and several other blockchains for a while now. One of their executives was talking openly about it. He said they interface with financial institutions all over the planet. They were early and aggressive in getting into blockchain. They started experimenting and quickly realized that there might not be just one single winner. Blockchains are basically technologies that will keep improving over time. In this new information-based economy, they see blockchains as utility rails or pipes that move information around, so they want to be connected to as many of these different ecosystems as possible, because that's where their future customers will be. They don't see it as a one-winner-takes-all situation. Instead, they look at these blockchains like digital nation-states. Each one has its own economy, and those economies are aggressive about growing. Franklin Templeton wants to grow alongside them. Whether they bring securities products or other services on top of those rails, they want to be present where the action is. Right now, they're active on either 10 or 11 different blockchains. What's really cool is that Franklin Templeton has been working with Ripple and the XRP ledger for years, even during the darkest days of the SEC lawsuit when things looked really tough. They stuck around and supported the project. When you hear big institutions openly saying these blockchains are like digital nation states with their own growing economies, it makes you realize how huge this shift really is. They're telling everyone who's paying attention exactly what the game is. Even the Federal Reserve Chair, Jerome Powell, spoke recently and mentioned some concern. He said that after you adjust the recent job numbers for what they think is overcounting, there's effectively zero net job creation in the private sector right now. That's got some people on the Fed committee paying close attention because it's not the kind of healthy growth you want to see. Anyway, that's pretty much everything that's been going on in the last few days. The ICBA trying to block those trust charters, the Clarity Act getting delayed again, Coinbase protecting their big revenue stream from Circle, the fight over stablecoin yield holding up the whole bill, Ripple quietly building real partnerships while others fight, BlackRock talking about how everything might eventually get tokenized, Franklin Templeton spreading across multiple chains, low retail attention while institutions keep moving forward, and even some macro worries from the Fed. It's a lot to take in, but if you zoom out, you can see two different worlds happening at the same time. One is the short-term price noise and retail traders stepping away. The other is the big institutions, banks, tech companies, and regulators slowly but surely building the infrastructure for a tokenized future. The Clarity Act is supposed to be the rulebook that makes all of this safer and clearer for everyone in the US, but right now it's stuck in the middle of a fight between different interests. XRP holders who've been through the 4-year SEC battle are watching this closely, hoping the bill can still pass in the next few weeks before politics takes over completely. A lot of people feel like the industry as a whole needs this legal clarity so innovation can stay in America and everyone can build without constantly looking over their shoulder. That's the real story right now. It's messy, it's political, there's real money on the line, but underneath it all, the big players are still moving forward with tokenization and blockchain tech no matter what the daily price is doing. If you're thinking long term, this period of low attention might actually be one of the quieter times to get positioned before things start picking up again. Man, there's just so much happening every single day in this space. One day it's regulatory letters, the next day it's big institutions talking about tokenizing everything, then you get quantum computing reports, Fed comments on jobs, and all the while the Clarity Act negotiations are going on behind closed doors. It never stops. I could keep talking about it for hours because every piece connects to the others. Ripple building RLUSD the compliant way while avoiding the yield fight. Coinbase making $1.35 billion from the USDC deal and protecting that income. Franklin Templeton calling blockchains digital nation states and spreading across 10 or 11 of them. BlackRock saying the transformation could be massive, even if it's not guaranteed. The White House wanting fair competition and better rates for regular people. Senator Lummis saying this bill is the best thing for DeFi, the ICBA and traditional banks trying to slow down crypto charters. All of it is happening at the same time, and most people outside crypto aren't even noticing. That's what makes it feel like we're still early in some ways, even after all these years. The real infrastructure is being built quietly while the spotlight is off. So yeah, that's the full picture as it stands right now. The next few weeks are going to be really important for whether the Clarity Act moves forward or gets delayed until after midterms. If it passes, it could unlock a lot of things for developers: self-custody, token classification, and the whole industry. If it gets blocked again, we might have to wait a long time for another shot. Either way, the institutions aren't waiting. They're already placing their bets on tokenization, multi-chain strategies, and a future where assets live on these digital rails. And that's the part that makes you realize the long-term story is still very much alive, even when short-term noise and politics get loud.